Hey traders, this is a video on how to find low risk, high reward trades. Okay, so I'm going to do this in the past, and just because it takes so long to do them in present. So I'm going back to some trades that happened here in the last day or so, so you'll be able to see how you could have found that that was an opportunity. All right. So one of the things you got to do is you've got to identify, all right, wide open spaces in the charts. Okay, so you can see this one right here. All right. You say, well, that doesn't look like a wide open space. Yeah, there's a couple of things in here, a fib, and then we're here, and then you got a double top here. So those are barriers. But you can see this whole thing is wide open except for those, all right? Now, what do I do with those? That's where you move your stop, okay? So this is just simply a swing low, swing high on an extension, Fibonacci extension. It gives you these right here. It gives you the overall target, which is way up there, okay? And this target right here is the ATR, all right? So there are multiple targets every day. Sometimes it's the heart line for the channel, sometimes or the trend, sometimes it's a 1.618 fib, sometimes it's a 270 fib, sometimes it's the ATR, sometimes it's the 1000 fib, all right? So the most accurate way to do it is to figure out where the ATR is for today and where are you in it, all right? So I'm going to pull up the ATR for you. All right, so I got the ATR up and make it a little smaller here so it's easier to see. And there we go. All right. So I'm sitting here on the pound yen. So we just scroll down to the pound yen. Okay, so it does 145 pips a day right now. Its 90-day average is 149. So it's right in that range, a little lower than a half a year's worth of data, as you can see, about 12 pips lower than normal, but definitely within the range. Okay, so you can see this much data tells you it's going to do 140 to 150 pips a day. All right. Now, is that realistic from where I am? Okay, so that's what you look for. All right, so I'm here, and what do I see? Okay, so I've got MACD is just now starting to go up. I have a flag pattern. A flag pattern is always a continuation pattern, unless it's at the top or the bottom. But I only got in like this, so I'm only coming out like this. So the target for the flag would be the double top right there. All right, so how do I trade this thing? All right. So I know where the target is. And by the way, if you don't know where the target is, okay, a realistic target, if you don't know where that is, then you can't assess risk for reward. All right. So this is how to find low risk, high reward trades. But unless you know where the target is, you can't do it at all. All right. So this is the area that we would be targeting right up here. And we would be holding for the 270 fib up here. That's what we would be doing. All right, so what is my risk? Well, my risk would actually be down on a 10-minute chart. I'm not going to do that right now, but just because it's so simple to do it here. But down on a 10-minute chart, you would find the last, and going up, you'd find the last support where you can see it. It's the flag right here, plus 5 to 7 pips on an odd number. Okay, so that would put you right there at 183.17. All right, so this is your actual risk right here. Right there to 17. All right, there's my risk. There is my reward. So you can see it's a 1 to 6, probably 1 to 6, 1 to 7. All right. Now that's important. Why is it important? Because the lower your risk and the higher your reward is, the better opportunity, the less you have to be successful. All right. So let me pull up this graphic. It's pretty easy to see. And you can see here that if I'm looking for a 1-to-1 risk to reward ratio, okay, I'm going to risk 30 pips to get 30 pips. Okay. Do most traders do that? No, they risk 30, 35 pips to make 5, 6, 7, 8. All right. And that's why they lose. All right. In order to do that, you got to be 90% correct for the rest of your life, which is only possible if you are the greatest trader on the planet. Now, we never make a trade unless we have 55 pips or more, okay? So we're risking 30 pips looking for 55. We've got almost a 2-to-1 to start with. Well, you can see right here that I only need to be 20%, I can lose 40% of my trades, 60% of my trades, and I'll still show an increase in my margin account. Why? Because I've stacked the deck in my favor, so I don't have to be the greatest trader. Look what happens when you get down here looking for a 5-to-1 opportunity here. All right, you're profitable at 20%. All right. Now, what retail traders do is they go and try to grab pips, and thinking they're doing something. Oh man, I got 6 more pips than I had 10 minutes ago. It's awesome, man. I'm making money. You're not making money. You have set yourself up for failure. Right? You won the battle. You made 6 pips. You lost the war. You now got to be right 90% of the time for the rest of your life. Okay. So you take a loss of 30 pips and your average pip capture is 5. By the way, it's 5 to 8 is the normal for retail traders. 5 pips. Okay. You got to make 5 trades in a row. 6 trades in a row to break even. And you got to make 7 trades in a row, no losses, to pull ahead a lousy 5 pips. That's how you stack the deck against you. All right. So you got to go for more pips. That's it. All right. So let's just see what happened on this one right here. Let me get rid of these lines here. All right. So as you see, up we go. And where did we go? We went to, this is the first barrier, all right, that they hit and stopped dead. But they weren't done. They went ahead and went to the limit. You see that? Then they went to the next limit, which would have been our overall target. And then we're headed to this target today up here. Let me just get rid of that. All right, there we go. All right, low risk, high reward trade. So if you look at this now at the end of the deal, here was your actual risk, and here was your, here's your actual risk, and here is your reward, and you could have picked up all those extra pips. That'd be 1 to, I don't know, 1 to 7, something like that, maybe. All right, so there we go. All right, let's go find another one. All right. So get off this GJ here. Let's go over here to let's go to the GU. All right. So here's the GU. We're going to go before it happened. All right. Now, as you can see here, let me finish this off here. Let me take this HSI off. This is a tool that it's proprietary to us. And so since it's proprietary to us, it won't matter that much, okay, to you. All right. All right. So I can see an opportunity. Once again, the currency is doing a flag pattern right here, a flag pattern. Once again, I didn't come in from very low, I guess. So I've only got a little target right there to come out of that. So the first target is here. The second target is the ATR target up there. Now, the ATR on the pound dollar is dollar right here, 94 pips. It normally does 94 pips. In 180 days, it does 97 pips. So it does 95 pips a day, roughly, right? Day in, day out. That's 6 months worth of data right there doing 95 pips. So that's day in and day out. So that target is a rock solid target there, right? Does it mean it'll get there? No, but it means that for my purposes to define what is a low risk, high reward trade, that goes into it. Now you can see that there's a big wide open space or just this fib coming from the past in there, but I need to find the Fibonacci extensions in here. So I'm going to go to the swing low, the swing high, back to the swing low here of this move, and that gives me the 1,000 fib. Now, why is the 1,000 fib so important? It's because it's 100% of that move right there. So you can see right there, 100% of that move. All right. So many, many times that's all they'll do is the 1,000. All right. But we would still hold for the ATR. We'll hold for the 1270. We'll hold for this double top up here. And then we'll hold for the 1.618 Fibonacci extension. Which one is it going to go to? Well, I don't know which one it's going to end up at. But what I do know is I can define whether I have a trade or not and an opportunity for a low risk, high reward trade. So once again, you can see the opportunity is right here. There it is, right there. All right. So what is my risk on that trade? My risk is right here, this little part right here. So there's my risk. Okay. So if I take it here, that would be great. If I don't take it there and I take it on the break hook and go to the top, then my risk is here. So you can see here, this is less of an opportunity. This is a 1 to 2, all right, which means it's okay. As long as I have 1 to 1, it's okay, but it's not as good as that pound yen was, all right? So let's go see what she does. And there we go. And as you see, it blew right on through there, blew right through there, and went right to that target. Now, this is a good lesson of why you hold for the targets. You get to the limit, and you move your stop and hold in case it goes to the next one. Goes to the next one, move your stop and hold in case it goes to the next one. Move your stop and hold in case it goes to the next one. Well, look what it did. It went to all of those targets right there. Now, the original trade was based on only this. So what did I pull out? I pulled out 3 times more profit on that trade. And by the way, we did make that trade, right? So there you go. Let me kind of get off of here and go into maybe an exotic over here, and let's look at New Zealand yen. I'm going to do this, before the trade. All right. So let me go back here, and I'll show you how to put the ATR on. Let me just get rid of this. Come here. Let me get rid of it. All right. So the ATR is at the New York fix every day. All right. The New York fix is 5 o'clock. You got to know where that is in your world. All right. All right. So if you're across the pond, it's in GMT. If you're here I'm in Central Time Zone, and so it's the candle was a 1600 candle for me. All right. But if I was on the East Coast, it'd be the 1700 candle. If I was on the West Coast, it'd be the 1400 candle. Right. All right. So New Zealand yen here has a 80 pip ATR. Normally does 82 pips in a 90-day period per day, and in 180 days worth of data does 87. So 80 to 85 pips is a normal thing. Now that's a day in and day out. You know that's in play. And by the way, the ATR is the day chart candle before it happens. All right. So let's go find the 5 o'clock candle right over here, and that's 1600 for me. Okay, so that's where it is right there. Let me point it out here. This is the candle right there. However, after the New York fix, we put a new low in after that. So once you do that, you use the new low. All right. So there we go. Let me pull this back up, the ATR, and New Zealand yen, 80 pip ATR. We find that 5 o'clock candle. We go to the new low after the New York fix, and we're going up for 80 pips. All right, 80 pips. All right. And there we go. And you see, easily went to target. Do I hold for the next one? Yes, I do. Do I hold for the next one? Yes, I do. See what they did? Right there. All right, now let's take it back here. Now you can see where it looked like in this part right here. All right. So you had a little slope support right here. So you put that on. All right. It's coming right down through there. All right. And the break in here is going to give you the opportunity. What's my risk? Okay, my risk is going to be 5 to 7 pips under the last support, which is right there. So there's my risk, and there's my potential reward to the first target, the lower target. All right, and if I get all this, that'll be even better. All right, so risk is right here, reward is right there. All right. Now you can see the MACD is starting to make a rollover, starting to push back up right there. So we can quickly see what they did. And by the way, this is how you practice it. You practice in the past because you have the data that they had, and what did they do with it, all right? So let's see what they did with it, all right? Oh, I'll get rid of that. There we go. And put that back right there. Okay, so in the break there, up we go to the target, up to the target, up to the target, all right? Once again, what is the risk? The risk was right here, 5 to 7 pips below that line right there. There's my risk, and here's my reward. If I go to first target, if I go to second target, if I go to third target, what if I go to the fourth target, all the way up there? Right? Is that a great risk to reward trade? Yes. So here's the thing to remember. Just because I have a trade setup does not mean I have a trade. The decision to make a trade is based on reward for risk. If you don't have reward for risk with your trade setup, you pass on the trade. All right. Now, what happens to traders is they don't know where the currency is trying to go, and so the first time it starts to pull back or stalls out or whatever, you get scared and you push the button and take the trade off. All right. Now the bankers don't do that. The reason they're stalling out or they're even pulling back is because they need to find more buyers to go to target. All right. Every movement, no matter where it's up or down, up or down, up or down, every movement like this has to have a pullback in order to bring more buyers in to take it to the next one. Has to have a pullback in order to get more buyers in for the next move. And you can see it right there. All right? Doesn't matter where you go back in the past. All right. So after you do this a while, you'll know that in order to go down, they got to go up. All right. In order to go down, they got to go up. In order to go down, they got to go up. In order to go down, they got to go up. In order to go down, they got to go up. See that? In order to go down, they got to go up, right? So there, look at that move right there, right? Totally told ahead of time that it was going to do that, right? So I hope that helps you. Talk to you later, everybody. Be careful. Talk to you soon.